Good afternoon, everyone. My name is Jeff Anthony, and I'm a wealth management advisor at our Tempe location for Wild Wealth Management Group. I want to thank everybody today for taking the time out of their busy schedule to join us for our third quarter market update call. This year has been a very interesting year in the markets, and I have the pleasure to have Gene Goldman, who is the Chief Financial Officer with Cetera Financial Group, join us today to help us break down the current economic environment. You currently can see Gene possibly on CNBC and other financial outlets providing his insights, and we're very fortunate to have him today. Before we get rolling with getting into the market comments or the market commentary, I wanted to provide an update on Wild Wealth Management and also our charitable arm that we have as well. We are pleased to announce that our nonprofit, Wild for Arizona, will be focusing our efforts on free arts for abused children throughout the third quarter of 2021. This is a locally based program that employs trauma-informed approach in all programs for children who have experienced such things as abuse, neglect, and homelessness. We have emailed an Amazon list of supplies to all of our clients. You can also find a link to our Amazon list on our website at wildwealth.com. Or if you would like to get more information on it, you can also email us at info@wildwealth.com. So we are very excited to be able to present that for the third quarter and give back to the local community here. A couple educational events that we will have as well for July and August. Ben Zamora will be hosting a webcast for investment basics. That is going to be taking place on July 28th. And then Trevor will also be hosting a halftime report in August, which we should be sending that out or be taking place on August 25th. I know that the last year and a half has been very volatile with COVID, and we haven't been able to have as many events as well. So we are pleased to be able to start providing those, providing those again. We have a dueling piano performance, which is going to be a virtual event that we will be hosting on July 22nd at 6 p.m. And further details will be coming. You should be receiving those in an email very shortly. So without further ado, I wanted to kick everything off. And Gene, I wanted to thank you so much for joining us on our call today and helping us make sense of these markets that we're going through right now.
Awesome, Jeff. Thank you so much. And everyone listening, thank you so much for listening today. Let me share my screen just so I'll have a few slides to go through.
Okay.
2 seconds. And okay, perfect. Okay, great. Well, thanks, Jeff. Thanks everyone for listening to this video. First of all, hello and obviously good day. Hope you're all safe and healthy. As Jeff alluded to, it's been a crazy, year and a half. So again, your safety and your health is of most importance for all of us. So as we kind of go into 2021, listen, in 2021, there's lots of enthusiasm around the markets, around the economy. So just think about this. We are in a very broad economic recovery. So for example, you look at expected GDP. GDP is the output of our country. It's expected to be between 6 and 7% for this year. That's huge. A normal year, it's like 2.5 to 3%. We expect GDP to be about 6 to 7%. And the stock market has really embraced this good news. If you look at the S&P 500, it's the broad stock market index. It's up about 15% as of today. Huge move in the market, really good news. The question we have to ask ourselves is this enthusiasm for the stock market, is it really warranted? And the short answer is yes. Yes. But we need to take an eye towards the future. As I've talked to you before, I've always said, listen, the stock market prices in events about 6 to 9 months in advance. So what we need to do is look at events that are going to transpire or likely to transpire 6 to 9 months from right now. So with that said, I'll discuss our 3 primary themes. And the themes, as we talked about before, really center around the economy going from this big, broad recovery to more of a mid-cycle recovery. As things start to still grow, they start to slow down a bit. So our 3 themes for 2021, number 1, the economic recovery has broadened, and we have so much evidence behind that. The second theme is that we're seeing mounting risks in the economy and the markets. And the third theme is that we'll see increasing market volatility. especially with valuations in both stocks and bonds are very, very high. So I'll discuss each of these three, but I really will spend the majority on the last two. We talked about the recovery last time. We talked about the data, the information, goods versus services. We talked about a ton of that information. And we are through this recovery. We are really knee deep in this recovery. But now we got to spend more time on these second themes about the risks and increasing market volatility. So let's go to the first theme. And again, this is the great news. And the economy has recovered very, very fast. And there's many reasons. The three key reasons behind this recovery that we're in right now are: number one is just the vaccinations. Number two, the stimulus in the economy. And number three is really this pent-up demand, this pent-up economic demand. So starting with the best news is the vaccination. And I know this is a lot of data on here, but this slide shows the percentage of Americans who have received at least one dose of a vaccine. And it's great. It's great news. And this has led to a drop in cases, a drop in hospitalizations, a drop in deaths. So this is really good. As you take this positive information and you look towards the economy, it's really helping to drive consumer confidence, because this vaccination really provides that light at the end of the tunnel. So again, you're seeing on the right-hand side of the slide, consumer confidence, us, you and I, we are becoming more confident in the economy and the environment because we're vaccinated. Really great news. If you look at this next slide, the importance about the consumer, about you and I, is that about 70% of our economic output is from consumer spending. So again, said another way is that if you look at economic growth, about 70% of it is just you and I spending money. And a confident consumer creates a very spending consumer, a consumer that spends a lot of money. You look at this slide, the slide shows retail sales. Retail sales have seen a huge surge, and you see this on the far right-hand side. People are buying. You and I, we're buying a ton of stuff. We're going to restaurants, we're going to bars, getting our haircuts. Again, we're spending a ton of money. But what I thought was interesting about this slide, and this just shows the strength of the recovery, is that during the Great Recession, so the Great Recession was from 2008 to 2009. It took us about 40 months to get to pre-recession levels in terms of retail sales. About 40 months. It was about 3.5 years. It took a long time. During this past recession, during this pandemic recession, it took us 5 months to get back to that pre-recession levels. So again, 40 months back at the Great Recession, only 5 months during this recession to get back to pre-recession levels. So all this says is that consumers, you and I, we are spending a lot of money, and this is really helping the recovery broaden dramatically. The second positive, in addition to the vaccination, is just stimulus. And I know every single time I've talked to you, ever since the mid-2000s to earlier this year, we talked. Mid-2020 and this year, we talked about stimulus. And as a reminder, stimulus is both monetary and fiscal. Monetary is basically the Fed coming in, lowering interest rates. When they lower interest rates, borrowing costs get lower, and basically it helps to stimulate the economy. Fiscal stimulus is the government spending a ton of money on cutting taxes, on sending out checks and so on. So if you think about fiscal spending, the government did a ton of spending in terms of checks to Americans, to increasing federal unemployment benefits, and the goal there was to compensate for the losses caused by the job layoffs. And basically, what we saw during this recession was that personal income actually rose, and that's an important point. Personal income actually rose for the first time ever during a recession. If you switch to monetary stimulus, and you look at this slide, monetary stimulus, again, is the Fed raising and lowering interest rates. Again, the goal is to lower borrowing costs. And back in March of 2020, the Fed came in and cut rates dramatically. They instituted a program called quantitative easing, which in a nutshell is basically buying bonds from financial institutions like treasuries and mortgage-backed securities and replacing these with cash. And this theoretically with supply and demand, more cash on a bank's balance sheet, they're going to lend money, and this really opens up the economy. If you look at this slide, the dark line here represents monetary stimulus. Again, this is the Fed cutting rates and buying all those treasuries and mortgage-backed securities. This has really helped the economy broaden dramatically because it's kept rates very low. It created this liquidity in the bond market, liquidity in the economy. It's really great news. Again, this is why it's helping to drive drive the recovery. Of course, if you look at the light blue line on this slide, and that's the stock market. The stock market has really embraced this economic recovery, and the stock market has rallied with it. And we'll talk about the stock market later because it's a very important point. The stock market has rallied dramatically in this recovery. So if you look at this next slide, it's this third positive. Again, the third positive behind this recovery is that there's a lot of pent-up demand behind the scenes. Really, that's going to help broaden this recovery, help to drive more positive economic data. You know, I mentioned that this recession was the first time that we saw personal income rose. Also, this is the first time that it was a services-led recession. People stopped going to restaurants and bars, but at the same time, people kept buying TVs and workout equipment and, you know, refrigerators and so on. Now with the economy rising dramatically, people are going out, they're traveling. You know, try go get a rental car. Rental cars are nearly impossible to get, or they're super expensive. Try booking a flight. Again, it's just very, very difficult right now. But as I mentioned before, retail sales are surging, and retail sales reflects things that have already been purchased. What about on a go-forward basis? And I love these two data points. On the left-hand side is what's called personal savings rate. And the personal savings rate is what we're saving. And you look at it right now, it's about 15%. Long-term average is about 6 to 7%. There's a lot of cash on the sideline ready to be used to buy things. Again, this will help drive this recovery. This is helping to drive that pent-up demand. On the right-hand side, remember the recession, it was a services-led recession. People kept buying TVs and cars and whatever during the recession. So this has created very low inventory levels. So as this slide shows on the right-hand side, it's a simple ratio of inventory to sales. And as the line falls, inventories have dropped dramatically. So companies and manufacturers need to rebuild inventory. Again, this is a positive for the recovery broadening. This is a positive for this pent-up demand. Again, all really, really good news. Also really good news is the labor market, and the labor market has recovered. I know there's some discussions around, you know, unemployment benefits and other issues, but let's talk about the labor market first of all. So the labor market, we've recovered more than half of the 23 million jobs that we lost last spring or spring of 2020. That's great news, and the employment picture is improving dramatically. And you'll see people talk about jobless claims, about the payroll report. One of my favorite ways to look at the unemployment situation is really the number of people that are unemployed versus job openings. So if you look at this slide plots that, and right now it's a 1-to-1 ratio. So therefore, for everyone unemployed right now, there's a job available. Back in in March of last year, the ratio was 5-to-1. So 5 people unemployed for each job available. Today it's about 1-to-1. Yes, there's issues around unemployment benefits, around childcare, around workplace safety. It's making it very difficult to find workers. Again, there are issues, but think about this. If you go to Indeed.com, I went and I checked it last week. Right now, if you look at manufacturing job listings, there are 75% more manufacturing job listings in Indeed.com today than there was pre-pandemic. There's 56% more construction jobs available than there were pre-pandemic. Even vets, you know, I adopted a dog during the pandemic and I'm looking for a vet. Right now, there are 51% more veterinary job openings than there were pre-pandemic. There are tons and tons of jobs out there. The employment picture is improving dramatically. You look at today, we saw jobless claims came in below 400,000. That's great news. Think about this, you know, since the pandemic started, we saw 20 straight weeks where we saw over 1 million people filing for unemployment claims for the first time. Today, we're trending down to about 380 to 390,000. That's great news. Yes, it's not at the same level it was pre-pandemic. Pre-pandemic, we're around 218,000 per week. But again, things are improving. So as the labor market recovers, as it improves, it should further drive consumer sentiment. It should further drive this pent-up demand. So if you look at this next slide, you think about this. We've got vaccinations, stimulus, and this broadening recovery are really going to help drive investor optimism. You know, that's why the stock market right now, the S&P is up about 14% year to date. Really, really good news that this recovery is broadening. And it's really driving stock market returns. So that's the first theme, the recovery broadening. And again, I didn't want to spend too much time on that, but again, I just really wanted to highlight some of the key data that we're looking at to say, Why is the economy broadening? The second theme is where I'm really going to spend a little bit more time on. I think it's very important. Today things are on the upswing. The economy is doing really well, and obviously investors are thinking that this good news in the economy and this optimism will continue for the foreseeable future. Yes, there's good news in the economy, but this is the important. We do see mounting risks. We do see some headwinds on the horizon, and there's three that we're watching very carefully that could pressure the markets. Number one, it's peak economic growth, and you'll hear a lot about this. So peak economic growth, really in a nutshell, this means, is this as good as it gets? Will the economy still grow, but not to the same level it has right now? The second concern is inflation, and everyone's talking about inflation, and I'll talk a lot about that. And the third thing I really want to focus on is China. Really, and people aren't talking about China right now, but China is important. China is starting to slow down very slightly, and it's important. So the second theme about these mounting risks, keep in mind, we're not bearish. I'm not bearish at all. We just see some risks are starting to increase that will create more uncertainty. So as I look at this next slide, this is something I showed you last time, but as we go into this recovery, and this recovery we are in right now, it's coming out like gangbuster. I talked about this earlier, that GDP is expected to rise 6 to 7%. In the third quarter of last year, just that one quarter, GDP rose 33%. Again, think about this. The long-term average is about 2 to 3%. We're seeing huge gangbuster numbers. And as I mentioned, peak growth, is this as good as it gets? So later this year and next year, we will face some difficult comparisons, difficult year-over-year comparisons. If you look at this chart shows the current expansion, and I've highlighted with the red arrow, along with the prior 7 expansions. And what you see almost immediately is that our expansion has jumped up dramatically compared to past expansions. And that's great news, that the expansion has been jumping dramatically. But the point that we're really focused on is that this expansion is very front-end loaded. Lots of the good news is really tied to the early part of the expansion. And let me kind of spend some more time on this. But again, our concerns are that some of this expansion, some of this really super amazing data is going to start to slow down. Still be good, but just start to slow down. Let me give you a great example. So if you look at this slide, and this slide plots ISM, and ISM plots ISM for manufacturing and services. And I know I've said this to you many times, but ISM is one of my favorite economic indicators. ISM stands for the Institute of Supply Management, and they produce 2 major indices. It's called PMI for services and PMI for manufacturing. PMI stands for Purchasing Managers Index. And what this is, it's a survey of a bunch of qualitative questions, and they're asked businesses or purchasing managers, how's business? Is it getting better? Is it getting worse? How's hiring? How's firing? How's supplies? How's inventories? How's competition? How's employment? How are prices? A bunch of qualitative questions that are kind of merged together. And whenever this index goes above 50, it's expansionary. Whenever it goes below 50, it indicates the economy is contracting, the economy is slowing down. And the beauty about these indices is that they're one of the first looks at the prior month's economy. So right now, it's early July. We have PMI for the month of June. So again, it's one of the first looks at the prior month's economy. The other point about PMI is that it has a high correlation to stock market returns. So again, it's a really important indicator. Above 50 is really good. Below 50 is not that great. What you see here on the far right-hand side is that both manufacturing and services have bounced back dramatically. They've surged dramatically. But if you look at the far right, both of these numbers have started to come down a little bit for the month of June. Services and manufacturing is starting to crimp down. Earlier this week, we got the services PMI that came in below expectations. It came in well above 60. Remember, 50 is great. 60 is phenomenal, but it came in below expectations. If you kind of look at the data, you're seeing a lot of comments from purchasing managers. They're saying, we're suffering from the lack of workers. We're suffering from the inability to acquire necessary supplies. We're having a difficulty to hire people. So again, businesses are starting to have this impact of difficulty finding labor, difficulty to find supplies. You think about inventories. Remember we talked about inventories earlier, that they're at extreme low levels? The most recent PMI said that inventories today are at record lows. They are at early 1990s levels. You know, I think about restaurants, and we're seeing a lot of restaurant comments, and they're saying our sales are out like gangbusters. We're kicking butt. We're back to 2019 sales levels, but really we're being hurt by the fact we have a lack of staff, and you're seeing this everywhere. So again, this data, this is a great example of peak economic activity. Again, is this as good as it gets? The data is really good. It's above 60, but now it's starting to slow down. Let me show you this next slide. And I want to kind of go over a simple example. I think I touched on this before, but I think it's such an important example because it explains the interaction between the economy, the stock market, and what investors are looking at. So when the economy does really, really well, what happens is that companies sell more stuff. You sell more TVs, you sell more widgets, you sell more sprockets, whatever you want to sell. You sell more stuff. When you sell more stuff, you generate higher earnings. And when you have higher earnings, investors tend to buy the shares of your company. So really, in a nutshell, earnings drive stock prices. And what investors love is positive economic data that exceeds expectations. So if the market expects GDP of 6% and GDP comes in at 8%, the market loves it. The market loves better than expected data. But if you look at this slide, and this slide kind of highlights the fact that why we're starting to see data roll over in the prior slide is that you're seeing a slowing down or a lack of positive economic surprises. So on this slide, when the line moves higher, data is exceeding expectations. It's coming in better than the consensus. When the line moves lower, you're seeing that data is coming in below expectations. It's missing what the market is pricing in. So if you look at this information, you're seeing an extreme shift in these surprises from very strong results versus expectations to very normal, and in some cases, weaker results versus expectations. So if you dissect these surprises, on the positive side, we're seeing positive surprises tied to business surveys, tied to gauges to the economic cycle, tied to consumer data, because we're spending money like crazy. On the negative side, we're seeing surprises come in below expectations on labor, on industrial data, on housing and real estate. Again, the data is positive, the data is great, but it's coming in below expectations. The data is starting to peak, it's starting to roll over. Here's another slide. Look at the slide. And this slide shows another sign of this positive peak in economic growth. What we plotted here is really two data points: loan growth along with cash at banks. And this is basically loan growth at banks and how much cash they have in their balance sheets. If you look at the purple line on the bottom, the purple line is showing that loan growth is starting to slow down. And this is important. Loans drive economic growth. The Fed is keeping rates low because they want people to borrow money to drive and build things and buy houses and so on. You're seeing loan growth start to slow down quite dramatically. So again, all I'm saying is with the labor market being, harder to find workers, supplies constraints, also with loan growth slowing down, what we're saying is that our first concern, our first mounting risk is that economic growth is starting to peak, that economic growth is starting to slow down. Again, the stock market is starting to grapple with. This is why today, as we record this, you're seeing the stock market down a pretty sizable chunk. So the other risk, the second risk that we're seeing, and you're hearing people talk about this, you probably heard people talk about this all the last 3 months or 4 months, is inflation. And inflation, you're seeing prices rise. And what concerns people about inflation is that when prices rise, you're seeing prices rise, for example, in commodities, in demand exceeding supplies, and also remember that recession that we had, that services-led recession. During the recession, people were still buying stuff. So that goods consumption is really exaggerating the lack of supply in where we are today. There's also, as I mentioned before, a shortage of workers. So if you take all this together, there's concerns around inflation, and investors don't like inflation. We don't like sharp jumps in inflation because this pressures earnings growth. All of a sudden, if costs are rising, it reduces profit margins, it reduces earnings, and earnings go down. Remember, earnings drive stock prices. If earnings start to come down, start to decrease, stock prices tend to follow. Again, this is not a guarantee, but I'm saying that there is this link between earnings and stock prices. Again, investors don't like sharp inflation. If you look at this slide, remember that ISM PMI we talked about? Well, within the PMI, there's a component called prices. And remember, above 50 is expansionary, Below 50 is contractionary. Look at this data. Look at prices on the far right-hand side. 92, unprecedented, 92 for manufacturing, 79 for services. Prices are rising dramatically. This is very, very inflationary right now. So again, we're watching inflation very carefully. If you look at this slide, core CPI, and I know this is a busy slide, but basically core CPI, this is consumer price index. So this is the inflation that you and I see when we go to supermarkets and restaurants. Prices are rising. If you strip out food and energy, you have core CPI. Core CPI on the far right-hand side has jumped dramatically. Inflation is rising. It has risen dramatically. If you look at this slide, and this slide I borrowed from our friends over at Yardini Associates, and think about inflation. One of the biggest components of inflation is wages. And there's a storyline out there that people say, well, wages are really muted and wages are going to be in check and we won't see that much inflation. It's true. The last payroll report that we got, we saw jobs creation came in well above expectations. That's a positive news. And then wage inflation came in below expectations, slightly below expectations. That's great news too. But if you take wages and you split them into two components, into one component that's based on non-supervisory and production workers, this is about 81% of the workforce, wages have jumped about 9.3% over the past 2 years. If you take wages for higher income workers, as you see here in the blue line, it's up about 4.8% over the last 2 years. So while net wage inflation has been kept in check, about 3 to 4%. If you break it up in terms of the majority of the workforce has seen about a 9.3% jump in wages in the past 2 years. Again, it's inflationary. So what's our thought on inflation? Our take on inflation is that the Fed is in a pickle right now. The Fed is in a difficult situation. The Fed continues to claim that inflation is transitory, and transitory means it's short-lived. And there's lots of reasons behind that. The number one reason you'll hear the Fed say is what's called base effects. And base effects means that last year inflation was so low because people stopped buying stuff. We were in a pandemic, so prices fell dramatically. And this year, because of year-over-year in numbers, you have base effects. This year, inflation is high because it's base effects, but they say it's transitory. Our concern is that the Fed needs to be exactly right, that it is transitory. And there's so much evidence that the inflation may not be transitory as they suggest. Think about used car prices. Those have jumped dramatically. Yes, we can say there's a shortage of supplies of semiconductors, but think about that. People are buying more cars now because they're no longer living in the cities as much as they have. So now they're not taking public transportation as much. They're driving more. This is creating demand for cars. So yes, it looks transitory in terms of the inflation being short-lived, but there's some longer-term themes in play that suggest that inflation could be here longer than expected. We do think that the truth is somewhere in the middle between transitory and long-term. Again, we're watching inflation very carefully, but again, the concerns about inflation is that if inflation jumps or it proves to be less transitory than the Fed expects, what does the Fed have to do? They have to start to raise interest rates. When they start to raise interest rates, this slows the economy down. Remember the whole thing we talked about before. Lower rates equals lower borrowing costs. Higher rates equals higher borrowing costs. So again, we're watching, inflation very, very carefully. The third sort of risk we're seeing is really China. And China, as I talked about before, China led us out of the recession last year. They were the first country, unfortunately, hit by the pandemic, and they really addressed it with dramatic stimulus, similar to what we did here in the United States. Now, the problem with China is that they've got a lot of excess in their economy in terms of lots of expensive prices, lots of high prices, lots of just exuberance in their economy. And China sees this. So now they're starting to normalize their monetary policy. They're starting to reduce their monetary policy. They're starting to reduce the stimulus. You're seeing, for example, speculation in properties. People in China are buying properties like crazy because money is so cheap. Sounds familiar here, right? Exactly. You look at this slide. This slide plots PMI, and this is another PMI. So China, between us friends here, listen, China produces some data, and there's always a suspect. Is it actually accurate data or not? And we can spend another conference call to discuss whether it's accurate or not. What we look at is an index called the Caixin PMI. Caixin it's a fairly independent company from the Chinese government, and they do their own survey. They do their own PMI surveys. Again, above 50 is good, below 50 is bad. Look at the slide on the far right-hand side. The Chinese manufacturing is below 50. The Chinese manufacturing is close to 50, 50.2, and Chinese services is below 50. Again, the Chinese data is starting to slow down. This is important because China is a huge world economic player, and we need to, this is something we're watching carefully in terms of what the ramifications are. So again, another risk that we're watching carefully. So again, things are really going really well in the economy right now, but there are mounting risks that could impact this optimism. So one thing that you're seeing a lot lately in the news is the 10-year Treasury yield. So the 10-year Treasury yield has come down. At one point, as you see in the slide here, at one point it was about 1.75%, and now today it's about 1.28%. It's a huge drop in the last 3 or 4 months. Why is that important? Well, first of all, the 10-year Treasury yield, it tends to be what mortgage rates tend to be based on. There's a bunch of formulas, a bunch of quant people, but basically around the 10-year Treasury yield is what links towards a mortgage rate. So it's an important interest rate that people look at. What's really concerning about this sharp drop, people like lower rates. Rates come lower, it's good news because borrowing costs fall. But the sharp drop in this yield suggests that bond investors are worried about the economy slowing down. They're worried about something down in the horizon. This is what's worrying investors right now. They just don't see what's going on. And because of this, there's a little bit of concern in the market. So investors are buying treasuries as a way to reduce their risk in their portfolios. So I'm not trying to say, oh, things are going, it's a bear market. All I'm saying is that the treasury market is signaling that things are starting to slow down. Again, we'll have more information as data comes out, but at the end of the day, the treasury market, the bond market, because of the sharp drop, it's saying there's something coming down, whether it's slower growth, whether it's worries about the Delta variant, whatever it is, there's something that's really worried about the bond market. The bond market tends to be an early predictor of the stock market. If you look at this next slide is called the yield curve. And basically, what it says, what I applied here is the spread. It's the difference between the 2-year Treasury and a 10-year Treasury. I'm not going to go into what all this means, going into it, but really, in a nutshell, the markets and the economy, they want a steeper yield curve. They want the 2-year rate to be very low and the 10-year rate to be higher. They want that spread because, one example, banks tend to borrow money from us through our savings accounts around the two year. Around the short-term yields, and they tend to lend money out at that 10-year rate for mortgages, for other interest rates. And if that spread is wider, it's good for the economy because banks are lending money. If it starts to narrow, which it's starting to do on the far right-hand side of the chart, this suggests that there's concerns about the economy. So again, this is something that the bond market is signaling to investors, hey, something is coming, watch it carefully. So again, I'm not trying to run around and say, run, head to the hills. All I'm trying to say is that the bond market is starting to embrace the fact that we are through peak economic and peak earnings growth, and this could see an impact on the economy. So let me get away from that bad news. So again, 3 things that these 3 headwinds that we look at. Number 1 is the peak growth. Are we at peak economic growth? Is this as good as it gets? Number 2, potential for rising inflation. And number 3, the impact of China slowing down on our economy and the global economy. So if you take sort of this next thing, right, a third and a final theme is just increasing market volatility. And, we've been highlighting this for a while. And we do believe volatility will pick up. And let me talk about some of the reasons why we kind of point to this increasing volatility, or what can really extend this volatility. And number 1 is just simply, you look at this slide. This slide shows that investors are very bullish in the stock market. So if you look at the slide, I plot both margin debt and stock market performance. Margin debt is people borrowing money to buy stocks. And when you're very optimistic, when you're bullish, when you're out there getting crazy, you're borrowing money to buy stocks. And that's a sign of sort of this over enthusiasm, this over optimism. This is kind of worries us. What this leads to is what's called higher valuations. So we talked about this before, but as a metric to look at valuations, there's a simple ratio: price to earnings. So price of the index, in this case, the S&P 500, divided by earnings within the index, and that's called the PE ratio, price to earnings ratio. Higher is expensive, lower is cheaper. And if you look at this slide, excuse me, we are at early 2000 levels. We are pretty expensive. And we can justify it with lower rates. We can justify it with low inflation. But again, the problem with high valuations is that it's pricing in absolute perfection. It's pricing in a perfect scenario in terms of the economy and the stock market. If you look at this, remember, earnings drive stock prices. And I've said this many times. Okay, I know there's some assumptions built in, but basically, if earnings improve, stocks go higher. If earnings decline, stocks go lower. Look at this. So if you look at this slide shows that in the second quarter of this year, so second quarter, when we get earnings releases, we should see earnings rise about 62%. But then you see the arrow, the next few quarters, earnings are expected to decline. Still be higher, but expected to decline versus the second quarter. Again, this is a sign that earnings growth is starting to peak. Again, this is the thing the stock market needs to embrace, that we're not going to continue that 62% earnings growth every single quarter. It's going to start to slow down. And if you look at this next slide, one thing about the stock market is that we're seeing the stock market breadth is starting to weaken. So when you see a stock market move higher, what feels good is that most of the stocks are appreciating. You want a very wide market breadth. A market breadth is basically the number of stocks moving higher or lower in unison. And you see, like earlier in the middle of the slide, during the stock market rallies of last year and earlier this year, breadth was around 90%. Now look at the far right-hand side. You're seeing market breadth anywhere from about 30 to 40%. This suggests that while stocks have been higher, stock market's up about 14%. Only about 30 to 40% of those stocks have actually been able to appreciate, have been able to take advantage of the rally. We need widening market breadth. Without this, we do expect market volatility to increase. It's also not just stocks. Look at the bond market. So look at this. This slide plots high yield spreads. And what the spread is basically the amount of yield above a treasury that an investor wants to get compensated for when they buy a more risky bond. So again, when an investor goes in and they say, I want to buy a high yield bond, because high yields are a little bit more risky than the U.S. Treasury, they want a higher risk, a higher compensation for that additional risk. And as the spread starts to kind of get narrow and narrow and narrow on the right-hand side, that means there's less risk being compensated. That means bond prices are getting very expensive. And all I'm saying in this slide is that bond prices are very, very expensive. The spread is so narrow right now. Also, if you look at this slide, the slide plots what's called interest rate duration. And duration is basically the sensitivity of the bond market to interest rates. And the higher duration, the greater the interest rate sensitivity. Concern here is that if interest rates move higher, let's say all of a sudden that yields start to move higher, because duration is at such an extreme level right now, you could see sharp fluctuations in bond prices. So again, lots of things are going on in the bond market. All I'm saying is, I'm not saying, hey, stocks are going to crash, all that stuff. All we're saying is that expect a lot of market volatility. You have extreme valuations in the stock market. You have extreme valuations in the bond market. And at the same time, you've got this whole theme, the theme that we believe is growth is peaking in both earnings and the economy. Inflation is starting to pick up, and China is starting to slow down. All of these together should create a lot of market volatility. So again, as I kind of wind down, three themes that you need to remember for where we are. So right now we are in a broadening economic recovery. The economy is broadening dramatically. Great news. Things that, the economy is doing really well. The second is that mounting risks. You look ahead, the stock market is a forward-looking mechanism. It's looking ahead to these mounting risks of peak growth, of inflation, and China slowing down. When you take all this together and the stock market starts to kind of grapple this perspective that things are slowing down a little bit, or inflation is rising, or China is starting to slow down, especially with higher valuations, expect a lot of fluctuations in the stock market, expect a lot of volatility within the stock and bond market. So with that said, what does that mean for you? What do you do? What do you think about? What should you do? And as I've said before, there's two things you need to do. Number one is be diversified, have exposure to different parts of the market based on your risk tolerance. And that's more easily said than done. This is why the second theme is more important. The second thing you need to do is stay in contact with Trevor, with Jeff, with the rest of the team. Make sure that they know your financial situation. Make sure they know the risks that you're willing to take in place. Make sure they know everything about you and your portfolios. Because again, we are in a very different environment where things, have been really great for a long time, but we do expect a lot of market choppiness. And yes, choppiness, there's some downside, but choppiness also creates some investment opportunities. So again, talk to your advisor, talk to Jeff, talk to Trevor, talk to the rest of the team. And again, keep, please stay in contact with them. So with that said, Jeff, that's really all I have for comments today.
Awesome. Well, thanks, Gene. We really appreciate it. Those insights are invaluable to us, and you did a great job at breaking that down. I actually did have a couple comments or a couple questions that we have that actually probably comes up quite often in our client meetings. First off, that's most important though, we got to know what kind of dog you got.
I have an Aussie Shepherd mix. So I got him from a shelter. I was lucky. I was blessed to find a dog like that. So he's great. So he's actually working on his inflation calculations right now. So
awesome. Well, cool. Well, a couple questions that I had. First one that comes up quite often is, I know that when you did a great job of going over like the transitory inflation risk, and we hear about that in the news constantly. What's your input as far as how long you expect, or how long you would expect like the transitory piece of inflation to last?
Great question. So transitory, again, it's a short term. I mean, short term in nature. It's a word of 2021 for inflation. Right. So transitory most likely is going to be probably April, May, and June. So July, we'll start to get July data soon. It should start to come down. The problem is that the inflation going to fall as much as people are pricing in the market? If inflation comes down, that's great news. But if it's still above what the market expects, again, the market does not like negative surprise, and that would be considered a negative surprise. That's what could put the market in a tizzy right now. So we will get some data in the first couple of weeks of July in terms of inflation. Also, the Fed meets in late July to talk about their inflation reading. The big meeting is the Fed has a meeting in August where they'll go in and they'll talk about their projections and so on. So we'll see what happens there. But I do think transitory, I think it's going to be a little bit higher than people anticipate. And, there's so much evidence, car prices. Here's an example. I love burritos. And so there's a burrito shop around the corner, and, pre-pandemic, they're charging $8.50 for a burrito. It's expensive, very expensive. But then, now you go to the same burrito place, it's like $10, it's $1.50 more, but that's still almost a 20% rise in the price. So again, companies are using this opportunity to raise prices. So I think inflation is going to be longer than expected. And they're not going to all of a sudden say, my burrito is not going to, the guy that makes it is not going to say, hey, Gene, I just saw CPI came in lower than expected. I'm going to cut my prices by 25%. No, they're not going to cut prices. So we'll see what happens. So.
Okay. Awesome. Well, thanks so much for that. Last one, and I know that Trevor touched on this last time. So just kind of a follow-up on that is, we have a lot of people ask about, obviously, the housing market in Arizona, similar in California and across, different parts across the nation, have been extremely hot right now. What's your outlook on that? Is, I know that rates have been dropping. We talked about the 10-year dropping lower, which do affect, they do have a correlation between that and mortgage rates. Where do you see things moving forward, from here? Is it something that's sustainable? I know a lot of people are nervous about, there being a drop or a slowdown. Not that we can forecast anything like that, but just wanted to get your input on that.
Yeah, there's parts of the country, we have some bubbles in parts of the country. Is that even in where I live here in California, there's some bubbles. There's an extreme demand for homes. So what's causing this bubble is, as you said, low mortgage rates, and the Fed continues to buy mortgage-backed securities as a way to keep mortgage rates low. And second of all, it's just demand. There's this whole de-urbanization that people are moving out of cities and just buying homes. And you've seen all the stories on Reddit about, people paying $300,000 over asking, and also buying a seller's next home for them. It's just crazy stories like that. And here's another stat I saw, that there's actually more realtors in the United States than there are homes for sale. So you can see there's some bubbles and pockets of bubbles there. Our opinion, especially as lumber prices have come down. Remember, lumber prices, I was talking to a contractor, and like a sheet of plywood pre-pandemic was like $25. Now it's $100 for the same sheet of plywood. You know, as people go back to work, as we start to kind of produce more lumber, you'll start to see prices come down, and home prices should start to kind of level up, especially if we have peak economic growth. I do think it's accelerated right now, but at the end of the day, I don't see a crash in the housing market, because if you go back to 2007, there were a lot of issues that drove that, you know, extreme enthusiasm. There's also a very low home equity percent relative to home prices. Today, it's a different story. Home equity value relative to prices is much higher. So there's a buffer with it. Yes, prices could come down, but nowhere to the extreme that we saw in 2007. All I'm saying is there's like a bigger buffer in terms of home equity already built into some of these prices as opposed to it was back in 2007. So I'm not too worried, but there will be a pullback in prices. You know, they're just supply and demand. So.
Got it. Oh, awesome. Well, thanks so much for that insight. And again, thank you so much. I know that you have a very busy schedule, and we definitely appreciate you taking time out to kind of break everything down on the economic conditions for our clients. So thank you so much. We greatly appreciate it. And we wanted to thank everybody for being on the call. Thank you so much for entrusting us, you know, with your money and your financial future, and obviously supporting us along the way. I know through the pandemic and everything, everybody's been making as best as they can. And we're glad that we're starting to get on the other side of this, and hope everybody is well and has a great rest of the summer.